Welcome to the conference call of Aptus Value Housing Finance India Limited, arranged by Concept Investor Relations to discuss its results for fourth quarter and fiscal year ended March 31st, 2022. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. At this moment, all participants are in a listen-only mode. Later, we will conduct a question and answer session. At that time, if you have a question, please press star and 1 on your touchtone phone keypad. Please note that this conference is being recorded. I now hand the conference over to the management. Thank you, and over to you, sir.
Thank you. Ladies and gentlemen, good afternoon to all of you. I am Anandan, CMD of the company. I welcome you all to the conference call to discuss the financial performance for the fourth quarter and for the year ended March 31st, 2022. I have with me Mr. P. Balaji, ED and CFO, and Mr. G. Subramanian, ED in Business. The results and the investor presentations are available on the website of the stock exchanges as well as the company website. I hope everyone had a chance to look at it. Aptus had a healthy fourth quarter, as you must observe, and a financial year, which is reflected in our results. Disbursements and collections are back to normal levels after COVID. Total disbursements stood at 519 crores for Q4 '22 as compared to 405 crores Q4 '21, up by 28%. Disbursements for the year was at 1,641 crores compared to 1,298, up by 26%. AUM as on 31st March 22 was about 5,180 crores. First time we crossing the 5,000 crores landmark, which represented a healthy growth of 27%. Of course, despite a lower disbursements in Q1 of 22 on account of COVID. NIM for the year was at 13.66%, representing an improvement of 119 basis points compared to FY21. Gross NPA was at 1.19% after incorporating the revised guidelines of the RBI concerning the non-performing assets. We have registered an ROA of 8%, which is one of the best in the industry, possibly in almost twice of our nearest competitor in this segment, and an ROE of 14.45%. I would like to reiterate the fact, as I did in our earlier call, that we have enough on-balance sheet liquidity of about rupees 846 crores, including an undrawn sanction from the banks to the extent of about 300 crores. Our net worth stands little over 2,900 crores, which indicates robust capital adequacy in order to support the growth in future. Key highlights of FY22 performance being NII, net interest income, was about 632 crores, up by 40% over previous year, and NIM at 13.66, 119 basis points higher than previous year. Net profit at about 370 crores, is about 39% higher for previous year. AUM 5,180 crores, growth of 27% I mentioned earlier, and disbursements, there's growth of about 26% at 1,641. Capital adequacy is about lower 80%, and GNPA is about 1.19. ROA, I mentioned to you, one of the best in the industry at about 8%, and our ROE is about 14.45. I would now hand over the line to Mr. P. Balaji, our ED and CFO, to discuss various business parameters, supported by letter as and when it's required by Mr. G. Subramaniam.
Thank you, sir. As of 31st March 2022, total live customers were over 83,000. This represented a growth of 27% year-on-year. Total number of branches were at 208 as on 31st March. We have added 18 branches in FY22. We are happy to share that we have opened our first branch in Behrampur, Odisha. Employee count as on 31st March was at 2,271. Major performance highlights are as follows. Assets under management grew by 27% year-on-year to 5,180 crores. Disbursements increased by 26% year-on-year to 1,641 crores. NIM was at 13.66%, increase of 1.19% compared to the previous year. OPEX to assets were at 2.53%, reduction of 25 basis points as compared to the previous year. PAT was at 370 crores. This represented a growth of 39% year-on-year. ROA and ROE was at 8% and 14.45% respectively. Now coming to the asset quality, GNPA was at 1.19%. It has reduced from 1.53% in Q4FY22 and increased from 0.7% as of Q4FY21. This again is based on the RBI circular dated 12th November 2021. Net NPA as on 31st March was at 0.88%. Provision coverage ratio, which was at 0.41% as of 31st March 21, has been improved to 0.8% as on 31st March 2022. Collection efficiency for the fourth quarter improved to 103% as compared to 98% in Q3 FY22. Outstanding restructuring book was at a very nominal 1.2% of the total loan book. ECL provisions stood at 41.68 crores and Phase 3 provision coverage at 25% has been maintained. Ratings were been upgraded to AA- from A+ by ICRA. This will help us in exploring more sources of funding and also help in reducing the cost of funds. We have well-diversified borrowing. Of the total borrowings as on 31st March 2022, 50% were from banks, 32% were from NHB, 14% were from DFIs like IFC and large financial institutions, and the balance were in the form of securitization. We had sufficient on-balance sheet liquidity of 846 crores, including undrawn sanctions of 300 crores from banks. As on 31st March 2022, our net worth was over 2,900 crores. Now, with these remarks, I open the floor for the question and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to the participants, anyone who wishes to ask a question may press star and 1. First question is from the line of Mona Khetan from Dolat Capital. Please go ahead.
Yeah, hi sir, good evening. So firstly, on the ECL provisions, when I look at the total ECL provisions, they have declined from 430 crore last quarter to around 417 crore. So what is the reason for this?
So ECL provision as on 31st March 2022 is at 41.68 crores, whereas as on 31st December was at around 47 crores or 46 crores to be precise.
Yeah.
Why this has declined? Because of the improvement in the NPA. If you look at our NPA, which was at 1.53% as on 31st December, that has declined to 1.19% as on 31st March.
Okay. So, yeah, but then your P&L provisions are high and yet this number has declined. So have there been any write-off is what I was trying to understand.
As a matter of prudence, we have written off around 6.48 crores, which is having an overdue of more than 2 years. That is working out around 0.12% of the total loan book. But what has happened here is, the security and the adequate asset cover is there, so the legal efforts for recovering these monies also will be in tandem, and it will be continued.
Okay. So we have written off 6.5 crores this quarter.
Principal outstanding, yes.
These are all NPS more than 24 months.
Yeah.
So the assets and everything is there. We have taken a precautionary review on that.
No, the percentage of this is really 0.18% only. Right now.
Right.
0.12. Okay. 0.12. Again, at a broader level, at a policy level, we have really looked at it, and going forward, any overdues beyond 2 years, we will either provide 100% or will take a write-off 100%. While our recovery effort will continue, from the point of view of prudence and conservatism, the company has taken the call to really either any outstanding beyond 2 years will be either provided 100% or will be written off.
Mm-hmm. And cumulatively, where would our total write-off stand today? Over the years, how much have we written off?
This is the first year where we are writing off, and this is the first write-off we have ever.
Okay. Got it. And secondly, when I look at the loan growth, we have seen sharp sequential growth in top-up loans during the quarter. So just calculating it based on the breakup of loans that you give, I'm getting a over 30% Q-on-Q growth in top-up loans. So what exactly is going on there? Any color would help.
No, I don't know where you got this number, top-up loans, of increased by 30%. If you could share, if you can send me a mail on this.
Okay. Sure. So essentially the share of top-up loans has increased from whatever, if it was 3% last quarter, it has gone up to 4%. And of course, our loan book has grown by, a certain 8% or so. So that is resulting in a higher Q-on-Q growth.
Okay.
But in overall terms, our top-up loans are very significant, only at about 3-4%. So it is not a significant one. And also, there is no specific, other than the normal requirement, which is in line with the growth in the customer base, there is some growth. Otherwise, top-up loan per se is very small percentage.
Okay, got it. And on the liability side, so what is the share of your bank borrowings that are repo linked, and what sort of spread compression can one expect in a rising interest rate scenario?
Sure. Of the total borrowings, we have 62% of our borrowings in fixed rate form, which means the borrowings from NFCs, the borrowings in form of NCD and securitization, everything, and also to a certain extent bank borrowings. All these are constituting to 62% of our borrowings are in fixed form, and the balance of 38% is related to the bank MCLR, either 6 months or 1 year.
Okay. So nothing is repo linked?
Nothing?
Nothing is linked to external benchmark like repo?
No, not repo. Yeah. It is linked to the MCLR of the bank. Yeah.
Sure. And therefore, so in a rising interest rate scenario, I understand that a large part of your loans as well as borrowings are fixed rate. But what sort of spread compression can we expect now that, we are aware that interest rates are likely to rise here on?
Yeah. You are right that the interest rates are likely to rise. And to this effect, RBI has already announced, and there can be future announcement as well on this front. But what we feel is we are fortunate enough to get this rating upgrade just in December 2021, which means that we will be able to reduce our cost of borrowings, because there is the interest differential between a AA rated paper and an A rated paper is almost 1 to 1.2%. Even if you are not able to get this reduction of 1.2%, we are confident of getting 0.25 to 0.5% reduction from the current interest rates of borrowing. This coupled with the NHB support and also the fact that our fixed rate borrowings are at 62%, we are not expecting any increase in the cost of borrowing.
Sure. So even from here on, we...
May we request that you return to the
Sure.
questions. Thank you. The next question is from the line of Avinash Tanawade from Dalal & Broacha. Please go ahead.
Hello, sir. Thank you for the opportunity. If you could share the slippages and recovery number for the quarter and same for the last quarter.
You want the pre-closes and the recoveries, is it?
Slippages and the recovery.
Okay.
Basically, at a company level, our pre-closures are around about 7 to 8%, about 7.5% or so. But even of that, significant part, almost 80%, that is closer to 5% of the 7.5%, is really out of customer own funds. It is not loan transfer at all. So our loan transfer to other financial providers, loan providers, are only around 3% or so. And that is really, that's one of the reasons why, since our pre-closure rates are low, we are able to have a consistent growth in our, area. And as far as the recovery is concerned, we had some disruption in Q4 on account of monsoon Q3 on account of monsoon southern part of India in November and December. But that we have really fully recovered, resulting in our recoveries in Q4 went up to almost 103% of the billing. That's why we are able to in fact, we are able to in a greater way recover whatever we are not able to do that in the third quarter last few days because of the monsoon rains. So our recoveries have been pretty good in fourth quarter at about 103%.
Okay, and can you throw some light about restructuring assets?
As you know that the first COVID reaction, RBI has given both the moratorium and the restructuring. And the second one, they given the restructuring only, no moratorium. Our total restructured book is very nominal at about 1.2% only. And of that also, our recovery has been, pretty good. So in other words, this is one of the reasons why our stop bucket outstanding was, slightly higher in Q3, which to a greater extent we are able to bring it down in Q4. But even that may be slightly higher than our key competitors, mainly because our restructuring was really at a very low at about 1.2%. Because we have taken the call, while we will give to the restructuring to the genuine customers, but otherwise we have taken the call to minimize the restructuring as soon as possible and recover the amount.
And one last question. Your branches has opened, you have opened 5 branches during the quarter, but at the same time, the in-house team has increased by around 147 people. Mostly you have added in sales. So, can you throw some light where these people you have shifted?
Yeah. Basically, we have added majority of people in the sales, and some we have added in the collections department also. In the new branches where we open, we have added people, and also in the existing branches. And as you are aware, these new branches will take about 5 to 6 months to stabilize and then move forward doing a good disbursement. So there is a time lag between recruitment and the loan book growth in the new branches by about 4 to 5 months. And we have added some people in the collections also. And as I explained before, we saw good reduction in the OD numbers, and the collection was also very good.
Okay. That's it from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Dhaval Gara from DSP Mutual Fund. Please go ahead.
Hi sir. Thank you for the opportunity and congrats on good set of numbers. I had two questions. First is on the cost of fund. So if I understand correct, so basically you're not expecting much margin pressure in FY23 offset by the rating upgrade. Is my understanding correct?
Yes, your understanding is correct. This is what is going to happen. Because of the rating upgrade, we are expecting a 0.25 to 0.5% reduction in our cost of funds.
There are a couple of things. One is that clearly our rating upgrade, which got in December, should help us, on reducing our incremental costs. That's one. Second thing is that we also got substantial loan from NHB in the month of December. It's a 10-year loan
at 5.8%.
And that the full benefit of that also will get reflected, in the current year. And the third element is that, significant part of our loan book, are really on fixed loan nature. So the variable loans are really, and the impact of the increase in interest cost will happen over the next 3 to 6 months. So there will be some time lag also will be there in that.
Understood. The second question is relating to operating costs. So, over the last few years, I've seen, you've made steady progress to improve your cost to asset and even, sort of cost to income, there has been improvement. So just trying to think through, is there further room to optimize or broadly, on an annual basis, it should be in line with asset growth? Some comments around operating leverage.
Basically, our cost of the OPEX is one of the lowest in the industry. And as has been mentioned earlier, even the current year, there is some reduction was there. But then having said that, since we are really almost at the, bottom level of the OPEX, while there will be continuous improvement in our productivity, of people and branches and customers, everything. But we don't really expect going forward. We don't expect significant reduction in cost, further reduction in our operating costs. Same time, we don't expect it to go up either, because we will have the benefit of growth in year and the benefit of growth in business. So, and we always believe in ensuring a high level of productivity, both through right HR and right IT measures.
Understood. Just one last question relating to distribution. If you could provide some perspective as to how you are looking to expand distribution over next FY23 and maybe even FY24, just the next couple of years. How do you think about distribution, people, branches? That would help.
Yeah, thank you. Currently, FY March 22. We have finished the year with about 208 branches, and we normally add, around 20 branches in a year. In fact, even the last year, despite COVID and all, we have added about 16 branches or so. But this 20 branches we had budgeted to add every year after year. And these branches will get added. In the particularly if it is a newer state from the contiguous stage, that's where we have commenced our first branch in state of Odisha, Barampur. Now, apart from these 20 branches, what is of the 208 branches, closer to about the branches that are added in the last 12 months, 18 months, there are about on a branch-wise basis, if you look at it, there are about 23 branches which are added, which are added during the last 12 months, and there are about 48 branches which are added in the last 24 months or so. We expect good loan book growth in these branches, in the branches that have been added, in the last 12 to 18 months. That is, second aspect. Third aspect is really in terms of apart from the branches and increased productivity out of the branches which are added in the recent past. We are expecting the productivity improvement of the staff in these branches also. Now, in addition to that, basically our entire distribution. The focus is really, we have been sort of focusing on few things. One is really in terms of what we call focus on our ecosystem, business ecosystem, meaning 80% of our loans are really for funding for these self-constructed houses. So we have sort of, working with the local eco partners, namely the hardware shops, paint shops, stationery suppliers, and things like that. And we have got, an app for it, and then that's one source through which we started, generating the inquiries. Then the other thing is that we have currently about 85,000 customers, and that will easily grow about more than 100,000, in the months to come. And we are also focusing on our existing customers through a customer app. And our target is to generate each customer generate 4 or 5 inquiries of their friends and relatives. So, through that, we want to, through the customer app to the IT and tap that. Third thing, sir, historically we've been always, our local branch network, all our marketing sales effort are done at the local level, at the branch level, at the field level. And that means in terms of the local pamphlet distribution, fluid board, participating in the local, events, if any, that direct inquiries also will flow in. So, in fact, all these years we've been sort of, in other words, the emphasis of the company on a third party or a DSA kind of system is minimal. The emphasis of the company is really directly acquiring the customers and directly generating the inquiries. And that's what we will, use our existing sales and marketing at the field level and also strengthen our ecosystem app and the customer app.
Thank you so much, sir, and wish you all the very best.
Thank you, Dhaval.
Thank you. The next question is from the line of Manoj Oberoi from Yes Securities. Please go ahead.
Yeah, sir. Hi. Congrats on good set of numbers. So, sir, I had a few questions. Firstly, on stage 2 coverage. So, when I look at our stage 2 coverage, it seems to be lower than our peers. So, how do we look at it? And also, if you can give out some credit cost outlook for FY23.
Actually, if you really look at the overall, we have ECL provision. If you look at March 21, we have made at the company level total ECL provision of about 16 crores. That we have increased to about 42 crores. In fact, whatever profit that we reported, 39% higher than the previous year, after this enhanced provision for the, towards ECL. In fact, in percentage terms, our ECL provision, which was about 0.4, has been increased to 0.8, almost doubled. And when you come to on a stage-wise basis, if you really look at, for example, provision coverage for NPA, we are really, it's about 25%. We have compared the data of some of our key competitors also. They either same or they're slightly less than us, actually. Coming to stage 2 that we are talking about, there also in the current year, we have increased from 0.5 of March 21, we increased to 2.2%. And in fact, even stage 1, some 0.09, we increased to 0.34. So overall, we have really, increased the provision, ECL provision from 0.4 to 0.8%. In other words, from about 17 crore, 16.8 to be precise, to about 41 crore. And in addition to that, we have also taken a policy decision to write off any outstanding beyond 24 months. That's that is not counted into this.
Correct. So, sir, you also spoke about write-off and that legal efforts will be taken for recovery. So then in that case, typically we would not take, legal efforts for recovery or repossession when the customer is NPL. So does it mean that we wait a little longer for taking the effort and recovery?
As far as our recovery effort is concerned, this is prudent accounting policy, write-off policy. But otherwise, all our recovery efforts, as far as the collection staff is concerned, branch manager is concerned, the recovery effort will continues to be same as intense as to be. All of them 100% secured, and our LTV is only about 35 to 40%, and we have the registered mortgage in our favor. We have initiated 138 arbitration, everything. That will continue. When we realize it, will get reported as the recovered amount. That's all.
So what is the FOIR that we typically keep for the new loans, on home loan as well as in small business loans?
It ranges from 45 to 50% income terms.
Yeah, and the income will be of the household?
Income will be on the household, yes.
Okay. And just lastly on the yields, when I look at the portfolio yields, so they have been pretty steady in the last 4-5 quarters. But I believe that we had also cut rates for home loans by about 50 basis points and other loans by about 25-30 basis points. And when I look at the mix also, the mix has moved slightly towards home loans in the last few quarters. So then ideally the yields should have declined than what they've declined by. So any comments here?
No, actually, if you really look at very closely in terms of ROE, yield has declined to small extent, about 20-30 basis points. Where is it, slide? It's 17.5. Yeah. Yield has actually, I'll give you the correct numbers. Actually, our yield has declined from about 17.63 to about 17.51. About 12 basis points reduction is there in the yield. But then, it got compensated by, our other recoveries of other income and fee income. That has resulted in our yield again at 18.717. It is about 18.17. So, but if you really look at the pure product yield, it has marginally come down by about 12 basis points.
Yeah. And sir, just last question is on the small business loans. So is our approach changing in terms of new business? So in the last 2-3 quarters, when I look at the growth compared to home loans, it's been a bit slower, and understandably so because of slightly difficult situation on the ground. But now with things normalizing in every way, can we then see that small business loans will grow in line with home loans? Or how do you look at portfolio or product mix in the next 1-2 years?
Business loan is a good product. We have been seeing it about 7-8 years. It is giving us good returns and also less NPA and good profit. So product-wise, it is very good, and all the collateral, all the customers are self-employed customers, and all the primary collateral is the residential property. So the product itself is good. There's no issues. Only in the post-COVID time, there was an issue. We were not very clear about what is the end use of the funds, whether these loans are elsewhere trying to come to organized sector and things like that. So we had slowed for about 7-8 months. But post-COVID, in the month of March and in the month of April and things like that, things have improved. So we will refocus on this particular product and we will grow as we have done in the past.
Correct. Sir, you had said your entire book is floating on the asset side?
No, on the asset side, 77% is fixed and 23% is floating.
Sorry to interrupt you, Mr. Oberon. May we request that you return to the question queue for follow-up questions.
Yeah.
The next question is from the line of Raj Mehta from Raj Mehta and Associates. Please go ahead.
Thank you, sir, for giving the opportunity. I just wanted to ask you, sir, now we are present in south side and we have a dominance in there. So when are you thinking to start towards the north side, Maharashtra side? And what is the trajectory of growth which you are looking for next 5 years?
Let me take the second part of it first. In the affordable housing finance segment, you must have seen that there is a significant population in the lower and middle income, largely living in Tier 3, Tier 4 cities, largely self-employed, who doesn't have any readily verifiable income documents. That need home loans are not really met, resulting in there is a large underserved market in the affordable housing finance segment, and the loan penetration percentage is very low. So going forward seems to provide good growth opportunity for many years to come, not only for Aptus, but for every other company which is in the affordable housing finance space. So at the overall market level, there is a market, given the low penetration, a sustainable growth rate is possible in this market. This is where we are looking at a growth rate of at least broadly twice than the overall mortgage industry growth rate. If the overall mortgage industry is growing at about 12.5%, we are aiming to grow at 25%. If the overall market is growing at 15%, we want to grow at 30%. On a sustainable basis, consistently, at least over the next 5 years, if not more. So that is the philosophy in which we are really, working with. That's one aspect. Second aspect of our question in terms of the branch, we always believed in the philosophy of, wider versus deeper. We believe in the concept of deeper, in the sense that we have taken upon ourselves to do well, extremely well, to be number one, to be in the market, to be the market leader in the area that we operate. That's why being headquartered in Chennai, we have commenced in Tamil Nadu, then extended to Andhra, Telangana, and Karnataka. So our philosophy is that wherever we want to operate, we want to operate, because this business needs to be, you have to be closer to the customer. You need to create the physical infrastructure, staff, and the whole thing. And we believe in a deeper penetration of wherever we operate, rather than wider on an all-India basis. That's where our philosophy in terms of, we will continue this philosophy of, we don't actually, we will not add branches because we need to be present in north, west, east business. We will add branches where it's absolutely required, and also helps us company strategy of continuous, growing in states which are contiguous to operations that we operate already. For example, that's where we have added Orissa. Because Orissa is really after, Andhra, the Orissa starts. And the first branch, Barampur, is really, almost closer to Andhra border. And that's how when we look at from the operating from northern Karnataka, we will look at Maharashtra. So our philosophy will be one of that rather than trying to see this company as an all-India company operating in northeast as also.
But sir, that won't be too much of a risk related towards a particular state. If anything bad happens, then how would that mitigate that risk, sir?
It is our experience has shown that these are really, even southern states, for example, is almost a population, about 250-300 million. And 4 different states, 4 different philosophies, 4 different chief ministers, 4 different languages, 4 different cultures. And yes, to some extent, there could be, your point is right, there could be some geography and this could be there. But that will overweigh in terms of our, because of, this concentrated approach, we are able to measure our risk far more better. But one thing that historically, if you see, some of the businesses, whether it is microfinance or home, even today, all affordable housing finance companies, they will be largely regional concentrated only. In fact, all the companies, affordable housing finance companies, if you really look at it, their 80-85% of the loan book will be from 4 states. Okay, they can, they say they are operating out of 12 states, but, there is, of the 12 states, they may have 5 states of, 2, 3, 1 branch each and 5 staff each. I mean, we don't believe in that philosophy.
Thank you, Mr. Mehta. May we request that you return to the question queue for follow-up questions. The next question is from the line of Franklin Moraes from Equentis Wealth Advisory. Please go ahead.
Yes, sir. Thanks for taking my question. So, considering that, we are growing quite robustly and we have a good growth plan in the future as well, just wanted to understand that, what are the checks and balances that, we take into consideration so as to avoid any kind of, fraud or any such kind of, lapses.
Yeah. As you are aware, we don't have fraud laws for last about 10 years. Some of the steps what we have done to reduce or eliminate the fraud laws, first primary thing is we don't have any outsourcing, be it in sales or be it in the collection. Second thing, all our credit decision is centralized to HO. It is not decentralized to the branches, and so is the processing. Third thing, when we open new branches, we take the credit bureau reports to see what are the market, how the culture of people, what are the repayments in this particular product and other products, and then we open the new branches. Fourth, very important thing, we follow something called early default. Any account which has been done in the first 15 months, we follow the accounts very closely, and what are the ODs resulting out of that, and those kind of learnings from the early default, we incorporate in our credit policy so that future we don't repeat the same kind of mistake. And on our the entire AEM of 5,200 crores, using the artificial intelligence and the machine learning, we do a lot of analytics to come to a lot of conclusions for identifying the opportunity for us to grow, and also the negative things where we have done some mistakes in the past so that these mistakes are not repeated in the future. So these are the kinds of checks and balances we have, and we are aware that when you grow fast, we need to have these kind of checks and balances.
Yeah. To add to this, there are two things. One is the robust internal audit and internal control mechanisms are there. Then the next thing is the reporting structure of the branches. Basically, the credit, legal, and technical at the branches report to the vertical head at the HO. They report functionally to the head office and they report administratively to the branches. So that also acts as a check.
Yeah, thank you very much.
Thank you. The next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah. Hi, sir. Congratulations for good set of numbers. So firstly, in terms of the processing fee, when we look at it, if you can just highlight in terms of how much would be the non-recurring in nature. No doubt there is increase in the disbursement, but still it seems to be slightly on a higher side, yeah.
We are talking of, processing fees is 2% we charge on the sanctions, and that is being collected at the time of sanction. Yeah.
No, so of the number which is there from 31 to 48, 49 odd crores for full fiscal. So if we, and even for this quarter, in fact, 17 odd crores compared to maybe 12, 13 odd crores in Q3. So would there be any element which is non-recurring and it might not be there in the
No, absolutely no. It is actually Kunal, it is. See, basically, the processing fee is done at the time of doing the new loan. A processing fee, documentation, whatever it is, which is also disclosed on our website, customers and all. That is recurring. But apart from that, there could be, some recovery in terms of your, particularly, in case of, in case of overdues, if there is any penal interest recovery is there. Particularly those accounts which are getting transferred or pre-closed, we are charging as permitted under law. We are whatever permissible penal and pre-closure charges will be charging. So that will also come there. But other than that, the numbers that you mentioned also will go in line with the kind of growth in the disbursement itself. A. B is that we also have the practice of recovering the penal interest wherever it is possible. Particularly in the Q3, as you know, we had a slightly larger, level of soft bucket outstanding, and which got collected in Q4. But we made these customers to pay the charges for the overdue interest. Okay. So that kind of thing, only that element can be sort of variable. Barring that, the processing fee it's all recurring. It's not one time.
It goes line with the disbursement growth.
Yeah.
Sure. So when we look at the disbursement growth largely from say 21 to 22, almost like 26 odd percent, or maybe even if I take 30 odd percent kind of a disbursement growth, then would it be fair to assume that 7-8 odd crores would be something pertaining to either the penal charges or foreclosure and all?
Yeah, it will be. Yes, that's right.
Okay, perfect. Got it. And secondly, in terms of the maturity of the borrowings, how much would come in for a maturity in, say, FY23 and FY24? And particularly anything high cost within this wherein we will get the cost advantage?
In FY24, some of the borrowings from IFC will get repaid. That is the highest cost borrowing which we have as of now, 10%. So to that extent, we will get the benefit in FY24. FY23, I don't see any 10% also. Even the borrowing from Templeton, which has been transferred to other parties, that also the maturity comes in FY24. That is also a high cost loan which will get repaid at that point of time.
Okay, so FY24, both the IFC as well as from Franklin, whatever are the high cost that will get repriced lower.
Yeah, exactly. Yes. That's right.
And quantum would be, if I have to look at it, the cumulative quantum of this, both of them?
This should be around 370-400 crores.
370 to 400 odd crores. Okay.
Yeah.
Okay, and repricing benefit could be, so on this, it will get repriced lower to the, so you said it was like 10% was IFC, you said. So you said like, okay, got it. Okay, perfect, yeah. And lastly, in terms of OPEX to assets, so if I heard it right, you were saying that it would neither go up much nor it would come off. But just wanted to hear maybe that there are a lot of investments which are being made by the other affordable housing. So, and we are working on a very, very lean cost structure. So any kind of specific investments which are needed either in digital technology, maybe branch expansion you have highlighted, but any specific element of cost which can come in over next 18 to 24 odd months?
No, actually we don't. We will incur relevant investments in particularly in our IT area, which we are doing already. We'll continue to do so, and we may increase it a bit also. For the IT, for digitalization, digital onboarding, digital, that will be there. Despite that, but we believe in a very high productivity of our existing branches, existing staff, and the number of files they put in. See, at every level, we look for, we are very conscious of two things. One is the actual expenses per se. Second is really the value that we get out of it. Whether it is really the branches or whether it is really even the branch operating, every component of the branch operating expenses, including printing, including stationery, including courier, including tea, coffee, including everything has been looked at, audited, we are very close on in terms of what is the expenses. Second, the productivity aspect of it. And how can we constantly this higher growth in volume disbursements? To the extent possible, we would want to come it out of the existing expenses rather than through additional new fixed expenses. So our basic philosophy is that, we will be around this even going forward.
And also IT expenses, more of CapEx will come rather than the revenue expense. So
that will be actually right up
over 3 years. Yeah.
Sure. Okay. Thank you, and all the best. Yeah.
Thanks, Kunal. Yeah, bye.
Thank you. The next question is from the line of Nischint Chawathe from Kotak Securities. Please go ahead.
Thanks for taking my question. Just taking this forward, given the fact that you will incur some IT expenses, would you expect the cost-to-income ratios or cost-to-asset ratios sort of inch up a little bit next year?
It will, but it will be compensated by a growth in our business volume and possibly reduction in the other expenses on account of the productivity, including IT productivity. Because now increasingly we started using, we incur the expenditure for IT, either hardware, software, networking, whatever it is. But same time, that also we look for what is the impact, suppose if we take collections. Now, tracking of the collection officers, tracking of their receipts per day, tracking whether, the cash has been deposited, digitally collected rather than the cash. We would look for, while we will invest in the entire package concerning the collection software, right from, production of the check bounce itself. We have got a tool now whereby closer to 90% production is possible in our check bounce. So we have invested in that. But then we will also use that, from check bouncing to 400 staff, collection staff, what they are doing on that day, how much they have received, they have collected, whether it is opening or for the month billing, and and digitally collected. Money has come in one day earlier and one day late. So we would want that also to pay for it.
Sure, got it. And just one small data keeping question. If you could give the breakup of the 10-odd crore of credit cost for the quarter.
Breakup of 10-odd crores.
Sorry, 10-odd crores of what?
For the quarter, 10 crores has been debited to the P&L.
Of what? Which 10 crores? Quarter. Okay. You say that.
Yeah. So basically, this is one is on the write-off, which is almost 4.3 crores. That is the net impact after the provision, plus the additional provision which we have made.
But this provision doesn't get reflected in the ECL, is it?
Yeah, because that has been taken out, because of the bad debt write-off.
No, sorry. So your ECL balance sheet provisions have not gone up, right?
No, ECL balance provision overall between the quarters, it has not gone up. Yeah.
Whereas from March 21, it has gone up.
No, sorry. So I'm just trying to say that for the quarter, when you have an expense of 10.5 odd crores, so ECL expense between the third and the fourth quarter has not gone up, right? So you have a write-off. What is the balance amount?
That is the additional provision which we have created.
Okay, but then that is not reflected in the ECL provision.
No, actually, this initial provision includes the write-off also.
Yes.
Okay.
Okay. So probably there is a write-off of around 10 crores.
While actually it is 6.5 crores is the principal outstanding. But the accrued interest, as it has said, accounting treatment-wise, it has to be reflected in the income also in the provision expenses. Yeah. So almost the entire 10 crores is really towards the write-off only.
Got it. I think that clarifies. Thank you very much and all the best.
Yeah. Actually, the almost entire, because see overall, if we really look at overall provision-wise, there is not much of increase, basically because, while the percentage provision has gone up from, from 0.4 of 21 to 0.8, they increased it. But then in terms of our NPS sort of come down from 73 crores to 61 crores. So because of that, the overall ECL provision has not moved up. But then the write-off really is comprising of two components. One is really the principal outstanding. Second is the auditors, as per accounting treatment, whatever they said, it has to be really in the income. You have to reflect their income and also reflect it as write-off. That's about it. It's a contra entry, basically.
Got it. I think that clarifies. Thank you very much.
Yes.
Thank you. The next question is from the line of Lavina Meghwani, individual investor. Please go ahead.
Thank you for taking my question and congratulations on good set of numbers. I have two questions. Sir, can you just give us a breakup of gross stage 3 assets which into RBI circular and actual DPD basis?
Yeah, I'll do that. The gross stage 3 is 1.19. This is as per the RBI circular. If you have not counted, you will have 20 basis point less. That is about 0.99.
Okay. And can you just explain us the increase in reserves and surplus of 950 CR? As you can see, the PAT number is for the year is at 370 CR.
And then we came with an IPO which brought in 500 crores of money into the company.
Okay. All right. Thank you so much.
Thank you.
Thank you. The next question is from the line of Ankit Bansal from AB Private Limited. Please go ahead.
Hello, sir. Congratulations on good set of numbers. So my question to you is now you are mostly situated in southern India. Now in your presentation, you are coming to markets like Odisha, Maharashtra, expanding yourself. So, sir, why customer will loan from Aptus rather than from big players that are being well placed in that market? And second, sir, what will be the growth drivers for the company to make it the level of HDFC, Kotak? So, what are your comments?
I take the second one first.
Thanks for that.
We are not really, wanting to be, we can never, I don't know whether we will ever become like HDFC, in terms of size and scale. But quality of operations, our earnings, our, return to the stakeholders, return on assets, be it the return on equity, and consistency of delivery of the financial metrics, transparency, and governance. All these parameters, we will benchmark them, we will, meet them, possibly we will exceed them also. Okay. But to talk about balance sheet size, I'm not able to answer the question now. Now, as far as the first part in terms of why should others really come to us, in Odisha and Maharashtra, and others are there, we have, the fact that, as I mentioned, we've started in Tamil Nadu and started growing on a continuous basis in the last, 10 years, over a period of time in the states of Andhra, Telangana, Karnataka. It's not that others were not present in these areas. But then when we entered, we have, the way of working, our culture, being closer to the customer, identifying the right customer, provide the good customer service, quick response, transparent in our operations. That has really helped us to rebuild the customer base progressively over a period of time. So same organization philosophy will help us to get the newer customers in the newer markets also. That's our belief.
Okay. So second one is, sir, with RBI increasing rates, you will be getting money at higher rates. Sir, you will be able to pass on those interest rates to the customer who are being somehow not willing, like the demand is decreasing in the economy? How would you be able to pass on those high interest rates to the customers in the newer market, like where you are not standing right now? You are just beginning in that market. So will it not be a good foray into that? Sir, that is my question.
As I told you earlier, we have got this rating upgrade. Because of that, the current cost of funds is slightly high. Considering the upgrade, we will be getting a reduction of around 0.25 to 0.5%. So there is no necessity to pass on this higher rate of interest to the customers because we will be able to sustain at this levels itself.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to the management for closing comments.
Thank you, and thank you, Gaurav
and Faizan.
And Faizan?
Faizan, his name is.
Faizan, for organizing this conference call. I would like to pay my sincere gratitude to all analysts and investor friends who have taken time out of the busy schedule to listen to us today. Please feel free to contact with us in case you have any further queries. We would be happy to get back to you. Thank you.
Thank you. Ladies and gentlemen, on behalf of Aptus Value Housing Finance India Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.